Since its inception in 1944, the World Bank has consistently appointed leaders exclusively from the United States. This long-standing practice reveals a deep-seated bias that compromises the institution's credibility, especially in its interactions with the Global South, the very regions it claims to support. From its inaugural president, Eugene Meyer, to the current head, Ajay Banga, the World Bank has maintained a tradition of selecting an American national as its president. This unspoken guideline underscores the United States' prevailing influence within the organization, bolstered by its position as the largest shareholder. Implications of American leadership. This practice carries profound consequences. A leadership monopoly held by Americans suggests a built-in bias towards the economic and political interests of the United States. Decisions regarding development financing and structural adjustments frequently mirror a neoliberal agenda promoted by Western nations. This approach has faced criticism for enforcing austerity measures and privatization strategies that often worsen inequality and obstruct sustainable development in the Global South. The lack of diversity in leadership perpetuates the perception of the World Bank as a tool of Western influence rather than a genuinely global institution. For the nations in the Global South, which represent the majority of its clients, the absence of leadership that embodies their realities and viewpoints raises serious concerns about equitable representation. The predominance of American leadership tends to align the institution's policies more with Western strategic interests than with the distinct needs of recipient countries. For instance, World Bank projects have frequently been criticized for favoring resource extraction or trade liberalization that benefits multinational corporations, rather than focusing on initiatives that address local developmental needs. IMF or Europe. The International Monetary Fund, IMF, much like the World Bank, has served as a fundamental pillar of global financial governance since its establishment in 1944. However, its leadership history reveals a troubling trend of exclusion, with Europeans consistently holding the position of managing director, from its inaugural director, Camille Goutte of Belgium, to the current leader, Kristalina Georgieva of Bulgaria. This pattern underscores the persistent dominance of Western nations within the institution. The European-led IMF has favored economic frameworks that align with Western fiscal conservatism, often prioritizing austerity, privatization, and liberalization. These policies reflect the interests of advanced European economies rather than addressing the developmental needs of the Global South. The predominance of European nationals in leadership roles perpetuates an institutional bias that marginalizes the voices of developing nations, despite the IMF's stated global mandate. This arrangement, particularly the shared leadership between the US and Europe, has resulted in a governance structure that centralizes decision-making power within the Western Bloc, effectively sidelining nations from Asia, Africa, and Latin America. Such practices echo a colonial mindset in contemporary global economic governance, highlighting the urgent need for a more inclusive approach that truly represents the diversity of its member states. BRICS and financial institutions. BRICS nations are advocating for reforms that reflect the economic realities of the 21st century. They argue that the current frameworks of the IMF and WTO disproportionately favor wealthier nations and fail to address the needs of the Global South. Their proposals include revising the IMF's quota system to empower emerging economies and restoring the WTO's dispute resolution mechanism to full functionality. Consequently, the Global South is dedicated to overhauling the existing Western-centric financial system and is even contemplating the creation of alternative institutions to meet its needs. In this video, we delve into the roots of the widespread dissatisfaction with the IMF and examine the policies in various Global South countries where IMF-backed loans have wreaked havoc on both the population and the economy. Let's dive in. Egypt. In January 1977, Egypt experienced significant civil unrest, commonly referred to as the bread riots, sparked by the government's decision to reduce subsidies on essential food items. This controversial move aimed to secure financial backing from organizations like the International Monetary Fund. but it resulted in immediate and drastic price hikes for staples such as bread, sugar, rice, and cooking oil. The sudden surge in prices ignited protests in major cities, including Cairo, Alexandria, and Suez. The unrest began on January 18, 1977, when workers in industrial regions like Helwan initiated strikes and demonstrations. Soon, students and other citizens joined the fray, leading to mass protests where participants voiced their discontent with the government and its economic policies. Tensions escalated as demonstrators targeted symbols of authority and wealth, including police stations, government buildings, and luxury hotels. Public transportation also suffered attacks, resulting in extensive property damage. On January 20th, President Anwar Sadat responded by deploying the military to restore order, which led to confrontations that tragically resulted in around 80 deaths, over 550 injuries, and approximately 1,200 arrests. Faced with mounting pressure and public dissent, the government ultimately had to reverse its decision and reinstate subsidies, which helped to quell the unrest. Brazil. In the late 1990s, Brazil faced a severe economic crisis that prompted the government to seek assistance from the International Monetary Fund, IMF, to stabilize its currency and economy. In November 1998, the IMF approved a substantial aid package of $41.5 billion, which was contingent upon Brazil implementing stringent austerity measures and structural reforms aimed at reducing fiscal deficits and promoting economic stability. These austerity measures included significant cuts to public spending, tax increases, and reforms in the public sector. As a result, the Brazilian government slashed funding for essential services such as healthcare, education, and social security, which adversely affected their accessibility and quality, particularly for vulnerable and low-income populations. The public response to these measures was fierce, with citizens and labor unions accusing the IMF of worsening poverty and inequality. Nationwide protests and strikes erupted as critics argued that the focus on fiscal austerity stifled economic growth and social progress, leading to increased unemployment and social unrest. However, some analysts contend that these austerity and structural reforms were crucial for Brazil's long-term economic stability, helping to control hyperinflation, restore investor confidence, and set the stage for future growth. Brazil's early repayment of its IMF loans in 2005 under President Luiz Inácio Lula da Silva is often cited as a sign of the country's regained financial independence and improved economic status. Nonetheless, the debate over the effectiveness of IMF-imposed austerity measures persists. While these policies may have stabilized the macroeconomy, they also impose significant social costs, raising important questions about how to balance economic reforms with social welfare. Brazil's experience serves as a poignant example of the intricate relationship between international financial aid, domestic policy implementation, and the socio-economic challenges faced by its citizens. Indonesia. In the late 1990s, Indonesia faced a devastating impact from the Asian financial crisis, which led to a dramatic fall in the value of the rupiah, soaring inflation, and severe economic turmoil. In October 1997, President Suharto's government secured a substantial $43 billion bailout from the International Monetary Fund. However, the austerity measures that followed ignited widespread public outrage. By May 1998, protests erupted across the nation, escalating into violent riots in Jakarta and other regions. Demonstrators targeted symbols of wealth and power, resulting in significant property destruction and looting, particularly affecting the Chinese Indonesian community. In response, the government deployed military forces to restore order, which tragically resulted in numerous casualties, with some estimates suggesting over 1,000 deaths. The growing discontent with Suharto's leadership, coupled with mounting pressure, ultimately led to his resignation on May 21, 1998, after 31 years in power. This pivotal moment marked the onset of Indonesia's Reformasi era, characterized by democratic reforms and increased governmental transparency. Nevertheless, the crisis and the austerity measures imposed by the IMF left a profound and lasting impact on Indonesian society, shaping public attitudes toward international financial institutions and influencing economic policies for years to come. Morocco. In May 1981, Morocco encountered severe economic difficulties, marked by a substantial budget deficit and escalating external debt. To tackle these pressing issues, King Hassan II's administration struck a deal with the International Monetary Fund, which mandated strict austerity measures. A key component of this agreement was the elimination of subsidies on vital food items, including flour, sugar, oil, milk, and butter. As a result, prices skyrocketed. Flour increased by 40%, sugar by 50%, oil by 28%, milk by 14%, and butter by a staggering 76%. This abrupt surge in food costs ignited widespread unrest, culminating in the Casablanca bread riots on May 29, 1981. Thousands of impoverished citizens flooded the streets, targeting symbols of affluence such as banks, pharmacies, grocery stores, and luxury vehicles. The government's response was swift and brutal, with police and military forces opening fire on the demonstrators. Official reports indicated 66 fatalities, while opposition sources claimed the death toll soared to 637, with many victims being young people from impoverished neighborhoods. The severe crackdown left enduring social and political scars, revealing the instability that often accompanies austerity measures in a society dependent on subsidized goods. This tumultuous period underscored the conflict between economic reforms imposed by international financial institutions and the harsh socioeconomic realities faced by Moroccans, illustrating the delicate balance between economic policy and social harmony in the nation's history. If you're finding this video engaging, please consider hitting the like button to help us reach a wider audience, and feel free to share your thoughts in the comments. Thank you for watching. Now, let's continue. Nigeria. By the mid-1980s, Nigeria was grappling with a severe economic crisis characterized by plummeting oil revenues, escalating external debt, and dwindling foreign reserves. Under the leadership of General Ibrahim Babangida, the country initiated a structural adjustment program in July 1986, crafted in collaboration with the International Monetary Fund. This program sought to diversify the economy beyond oil exports, foster non-oil industries, and achieve fiscal equilibrium. However, the immediate consequences for Nigerians were dire. The devaluation of the currency triggered inflation, driving up the prices of imported goods and essential items, while the removal of subsidies further strained the budgets of low-income families. Public frustration erupted into the anti-SAP riots from May to June 1989, beginning on May 24th at the University of Benin, where students protested with a mock coffin and green leaves, chanting slogans like "SAP must go" and "SAP is a vampire." This movement quickly gained momentum, uniting students, workers, and various groups across major cities such as Lagos, Ibadan, and Benin City, leading to intense confrontations with security forces. The government's military response resulted in numerous casualties and arrests. The stringent policies of the program contracted the economy, increased unemployment, and deteriorated public services, severely affecting the social fabric and exacerbating poverty and inequality. The government's harsh crackdown on dissent further destabilized the political environment, eroding public trust in leadership. While some contend that these reforms were essential for Nigeria's long-term economic health, the immediate social repercussions were profound. This period serves as a stark reminder of the dangers of implementing externally imposed economic strategies without sufficient social safety nets. Venezuela. In February 1989, Venezuela faced a dramatic decline in oil revenues coupled with escalating external debt, plunging the nation into a profound economic crisis. In response, President Carlos Andrés Pérez enacted austerity measures recommended by the IMF, collectively known as El Gran Viraje, or the Great Turn, which aimed to restore economic stability through significant structural reforms. However, the abrupt implementation of these measures ignited widespread public outrage. On February 27, 1989, protests erupted in the town of Guaycaipuro near Caracas due to increased bus fares, quickly escalating into larger demonstrations and riots across Caracas and other urban centers. This unrest, known as El Caracazo, prompted President Perez to declare a state of emergency and suspend constitutional rights. Government forces were deployed to quell the uprising, resulting in severe violence. Official reports indicated 277 deaths, but independent estimates suggest the toll could have been between 2,000 and 5,000, primarily at the hands of security forces. This brutal crackdown significantly eroded trust in traditional political structures, paving the way for Hugo Chávez's ascent. Chávez, a lieutenant colonel who had previously attempted a coup in 1992, capitalized on the public's discontent to secure the presidency in 1998. El Caracazo remains a pivotal moment in Venezuelan history, underscoring profound societal divisions and the volatile repercussions of sudden economic reforms. Pakistan. Since 1988, Pakistan has engaged in numerous agreements with the International Monetary Fund, each necessitating austerity measures and cuts to subsidies in an effort to address fiscal deficits and foster economic stability. Unfortunately, these measures have frequently resulted in considerable hardship for the public, leading to protests and political unrest. The initial agreements with the IMF included structural adjustment programs that mandated reductions in subsidies for essential goods and currency devaluation. The subsequent increase in prices for vital commodities hit low-income families hard, igniting public discontent. Under President Pervez Musharraf, Pakistan secured nearly $2 billion in IMF loans through two programs, but the required austerity measures, such as slashing government spending and further cutting subsidies, only deepened the struggles of everyday citizens, sparking demonstrations and escalating political instability. Opposition to the IMF's recommended reforms has persisted. For instance, in October 2024, the government implemented a 40% tax hike as part of an IMF bailout agreement, which triggered widespread protests. Critics contend that these austerity measures worsen inflation and unemployment while putting additional strain on public services. On the other hand, proponents argue that such reforms are crucial for achieving long-term fiscal health and tackling underlying economic challenges. Kenya. In the 1990s, Kenya adopted structural adjustment programs SAPs recommended by the International Monetary Fund and the World Bank to address financial challenges such as budget deficits and stagnant economic growth. These SAPs mandated extensive reforms, including the privatization of state-owned enterprises and cuts to public spending. As a result, officials sold off numerous parastatals to enhance efficiency and relieve budgetary constraints. By the end of 1995, Kenya had divested from over 100 entities, including 43 tea factories transferred to farmers, and reduced its stakes in major companies like Kenya Airways and Kenya Commercial Bank. To balance the budget, government expenditures were slashed in vital sectors like health and education, leading to the introduction of user fees. This shift made previously subsidized services more costly, placing a heavier burden on ordinary citizens and failing to deliver the anticipated economic revival. Between 1991 and 1993, Kenya faced its worst economic performance since independence, with stagnant GDP and a 3.9% annual decline in agricultural production. The cuts in public spending and the removal of subsidies disproportionately affected low-income communities, exacerbating poverty and inequality. User fees for healthcare further limited access for the poor, resulting in worsening health indicators and declining educational outcomes. Public discontent, fueled by the socio-economic challenges stemming from the SAPs, led to protests and political unrest. Many Kenyans perceived these programs as externally imposed and ill-suited to their needs, eroding trust in both the local government and international financial institutions. Experts have criticized the SAPs for exacerbating Kenya's structural issues, arguing that rapid privatization and austerity measures implemented without adequate social safety nets increased unemployment and underemployment. Furthermore, the focus on market liberalization neglected the necessity for strong institutions, creating opportunities for market failures and corruption. Criticism on IMF countries, particularly those in the BRICS group, have expressed significant dissatisfaction with the International Monetary Fund, IMF, due to its controversial lending practices and policy recommendations. The IMF has faced sharp criticism from nations in the Global South, particularly regarding its structural adjustment programs, SAPs, implemented during the 1980s and 1990s. These programs, which emphasized austerity, privatization, and trade liberalization, were intended to stabilize economies and foster growth. However, they often resulted in adverse effects, such as cuts to essential public services like healthcare and education, disproportionately impacting marginalized communities. Additionally, the focus on export-led growth has left developing nations vulnerable to global market fluctuations, leading to overproduction and declining commodity prices, which exacerbate poverty and inequality. Another major concern is the erosion of national sovereignty. The conditions attached to IMF loans are perceived as undermining a country's autonomy by compelling them to adopt specific economic policies. This external pressure can hinder nations from pursuing development strategies that are better suited to their unique socio-economic realities, often prioritizing the interests of wealthy creditor nations over local needs. Furthermore, the governance structure of the IMF has been criticized for favoring developed countries. The voting power within the organization is determined by a quota system that reflects financial contributions, which disproportionately benefits wealthier nations. This setup marginalizes developing countries, leading to decisions that may not align with their interests. Efforts to reform this system have been sluggish, and disparities in representation continue to exist, reinforcing the perception of the IMF as a neo-colonial entity that does not adequately address the needs of its borrowing members. The International Monetary Fund's IMF strategy for debt restructuring has come under fire for offering insufficient relief and neglecting the root causes of financial crises. Without a just global legal framework, debtor nations often find themselves ensnared in unfavorable terms, leading to cycles of borrowing and repayment that stifle sustainable development. This predicament can result in extended economic stagnation and a growing reliance on external aid. Furthermore, the IMF's focus on fiscal consolidation frequently necessitates cuts to essential public services like health and education. Such reductions not only impede long-term development but also exacerbate social inequalities, particularly affecting marginalized communities. These concerns underscore the intricate dynamics between the IMF and nations in the Global South, highlighting the urgent need for reforms that foster inclusive growth while honoring national sovereignty. BRICS alternatives. The BRICS nations are proactively developing financial systems that provide alternatives to traditional Western-dominated institutions such as the International Monetary Fund, an IMF. This initiative seeks to enhance financial autonomy and diminish dependence on the US dollar for international transactions. New Development Bank, or NDB, established in 2015. The New Development Bank, NDB, is dedicated to funding infrastructure and sustainable development initiatives in BRICS nations and other emerging economies. With an initial authorized capital of $100 billion, the NDB aims to enhance the financial landscape by offering support without the rigid conditions typically imposed by the IMF. This unique approach empowers member countries to pursue their development goals with increased flexibility and autonomy. Contingent Reserve Arrangement, or CRA, in 2015, the CRA was introduced as a strategic framework aimed at providing essential support through liquidity and precautionary instruments to address both current and potential short-term balance of payments challenges. With a robust capital pool of $100 billion, it acts as a vital financial safety net for BRICS members, offering a valuable alternative to the financial assistance programs provided by the IMF. Recent developments. In October 2024, At the 16th BRICS Summit, held in Kazan, Russia, member nations took significant steps to strengthen financial collaboration and lessen their reliance on Western-dominated systems. BRICS Grain Exchange. Russian President Vladimir Putin has put forth an ambitious plan to create a BRICS grain exchange, aimed at stabilizing food prices and bolstering food security among member nations. This innovative platform is designed to enable direct trade in agricultural commodities, reducing dependence on current global exchanges that are frequently swayed by Western financial systems. While the proposal has garnered support, experts caution that establishing such an exchange will necessitate significant preparatory efforts and could take several years before it becomes fully operational cross-border payment system. BRICS leaders have officially supported the establishment of a unified cross-border payment system aimed at streamlining trade among member nations while decreasing dependence on the US dollar. This initiative encompasses the creation of BRICS Pay, a decentralized payment messaging platform intended to facilitate transactions in local currencies. By encouraging settlements in national currencies, BRICS seeks to bolster financial sovereignty and foster a more equitable international monetary framework. Conclusion. A thorough examination of BRICS nations and various global South countries reveals a growing agreement that traditional financial institutions such as the International Monetary Fund, IMF, and the World Trade Organization, WTO, are increasingly perceived as outdated and misaligned with today's global economic realities. Several key factors contribute to this rising discontent and the call for alternatives. Firstly, these traditional institutions often operate with opaque decision-making processes, which hinder member nations from fully grasping and influencing policies that directly affect their economies. This lack of transparency fosters mistrust, as countries feel sidelined from meaningful participation in shaping the rules governing global finance and trade. Moreover, the governance structures of organizations like the IMF and WTO inherently favor wealthier, more developed nations. For example, the IMF's quota system disproportionately grants voting power to countries that contribute the most financially, marginalizing emerging economies and the global South. This imbalance perpetuates a system where the interests of affluent nations take precedence, resulting in policies that may not address the unique needs and circumstances of less wealthy countries. Additionally, the complex and often rigid frameworks of these institutions can be cumbersome and inflexible, making it difficult for nations to implement policies tailored to their specific economic contexts. Structural adjustment programs, while designed to stabilize economies, often lead to negative social consequences, including heightened poverty and inequality. This reveals a significant gap between the economic reforms imposed and the realities faced by local populations. Such failures have sparked widespread discontent and a call for more equitable and transparent financial governance. BRICS nations, along with other members of the Global South, are actively working to reshape the global financial landscape by establishing alternative institutions like the New Development Bank, NDB, and the Contingent Reserve Arrangement, CRA. These initiatives strive to ensure better representation, enhanced financial independence, and policies that truly reflect the varied economic conditions of emerging markets. Additionally, the creation of platforms such as the BRICS Grain Exchange and a common cross-border payment system demonstrates a strong commitment to reducing dependence on Western-dominated financial systems, promoting a more inclusive and cooperative global financial environment. Thank you for tuning into this video. We truly appreciate your presence today. If you found our content meaningful or inspiring, we would be grateful if you could show your support by liking this video and subscribing to our channel. Your engagement is incredibly important to us. Don't forget to check out another video from our channel that's currently displayed on your screen.